now, as I see, the Asian screen is looking pretty bright right now. Investors are assessing China's key lending rate decision coming in. Hong Kong is marginally higher. Shanghai is holding up a good 0.5% in the green. And Japan, of course, is almost headed in for a 950-point uptick coming in. And I guess, Japan is the one which really has been at the focal of the last 2 months of the global market move that one has seen. In fact, let's discuss that a little further. And we've got Peter Cardillo joining in on the show right now. Peter, hi, good morning and good evening to you. I guess Japan's now joining the list of countries, as many experts are calling it, where rate hikes are failing to strengthen the currency. How do you think the BOJ is going to really maneuver the situation going forward?
Well, I think, they're basically now in a tightening mode, and we saw that just last week. What was it, 31 years since they raised interest rates, and so I think that's going to continue. And we'll probably see another major attack on the U.S. currency as the carry trade unwinds. So that's the key point here. And of course, they're raising rates. It's despite of the fact that their economy is not really that strong. So we suspect that that's one of the reasons why we're seeing, and I say just one of the reasons, why we're seeing the strength in the precious metals.
Peter, how do you look at the last 10, we're going to the year end. How do you see trading, evolving for the last 10 days of this calendar? Are you going to see volumes being a little tepid? And flows, and from a point of view of flows, do you see flows going back to emerging markets, given that there's some kind of unwind happening in the AI trade?
Yeah, I think so. I think emerging markets will participate. India, probably, I would say, pretty much the one to look at over the next couple of months. I think that despite of the fact that we still have rates that are marginally higher, I would suspect that the outflows towards India will begin to pick up.
Peter, hi, morning. With regard to US, that there are two schools. One seems to suggest that there could be favorable tailwind in terms of rate cuts and much more than 25 bips, which is what the consensus seems to be. And some suggest that inflation will continue to remain sticky, above 2%. The 2.7 was a bit of a surprise, but nonetheless, it's still well above 2. And that will continue to remain and weigh down with regard to the number of rate cuts which will come through. Where do you sit on this one? Because that will largely drive flows as well, right?
Well, let's begin with interest rates. I think the Fed is going to be forced to lower rates by 2%. I'm sorry, by 50 basis points over the next quarter. And even though the dot plot from the last FMOC meeting suggested that there'd only be one, I think there's going to be two. And the reason for that is the Fed is going to have to sacrifice sticky inflation. And that sticky inflation is obviously emanating from the tariffs. And so, they're going to have to close their eyes on the inflation and concentrate on the job market, which is getting weaker and weaker and weaker. Now, there are several reasons for the job market weakening and likely to weaken even further. Well, you have layoffs from major companies, and that's in part due to the artificial intelligence. The second reason is, of course, the uncertainties of how the tariffs are finally going to play out on on corporate earnings. And the third reason is I think if you really look at the macro numbers very carefully, while we don't expect a recession in 2026, we certainly don't expect the economy to grow at 3 or 4%. That's, I don't think, anywhere in the cards. So we're calling for growth somewhere between maybe 1.6 and 1.8%. And that's not enough to avoid layoffs going further, simply because of the fact that you have this combination of the artificial intelligence that is beginning to eat at jobs. And so the administration's program to increase manufacturing and jobs here in the States, I think, is likely not to be fully achieved.
Right. Okay, Peter, great to have your insight with us. Thank you so much for your time today.
Thank you for having me.
Okay, let's talk about our markets. And while the global handover is looking strong,